Every stock, index, and portfolio of an Indian investor was bloody red in the month of February. I didn't get a chance to record February monthly wrap due to my travels, but it seems that it was better to not talk about that because we were all in a gloomy mood for that entire month. But now, as we see some recovery in Indian stock markets, I thought that this might be a good time to reflect on what is happening in the markets. In this video, we will break down why India's markets kept rallying until September 2024, what triggered the downturn in October 2024, and what is happening in February and March 2025. Stick around as we connect the dots between the market movements, the Indian economy, global geopolitical tensions, the Trump effect, and China's stimulus. Let's dive in. My name is Swapnil Karkare, a chartered accountant and economist, and here today we are going to talk about India's markets. But before that, please hit the like button, subscribe to the channel, and share this video across everyone. There are three things to analyze in India's stock markets today. First is valuations. Are stocks overpriced or not? Yes, they are. Second, economic growth. What is happening with India's economic growth? Is it supportive to the market gains? Probably not that much. Third, global markets. What is happening in US and China and how does it impact us? Let us start with valuations, the elephant in the room. For years, people have been saying that India's stock market is too expensive. Even before the pandemic, Indian stocks traded at a premium compared to similar markets. But why? The most important reason is the high expectation of profit growth. Investors believe that Indian companies will grow faster and they can make big profits. But when reality does not meet the expectations, stock prices fall. There's another issue in this. After pandemic, a flood of new investors entered the stock market. The market became frenzy. Everyone had a stock tip. Social media was filled with hot picks. You might even be added to some WhatsApp or Telegram groups without your consent, obviously, where they promise crazy returns. That said, we also have seen how many people are relying on stock trading, cryptocurrency, online betting, and gaming for primary earning source. This kind of hype is a clear sign of greed and desperation. Many of these new investors have never seen a proper correction in their lifetime. For them, stocks only went up. There have been times in the last few years where foreign institutional investors sold their stakes, but Indian mutual funds kept buying. That's how the market stayed afloat, thanks to the steady inflow of SIP investments from retail investors. This trend protected the Indian market from deeper corrections. But what happens if retail investors stop their SIPs? Well, that is exactly what has started happening. This wasn't an overnight shift as such. The market correction began in October, which was triggered by FIIs selling first. Then, as multiple concerns ranging from higher valuations to global uncertainties started surfacing, investor confidence took a hit. Slowly but surely, these worries intensified, leading to more SIP cancellations, which added further pressure to the markets. By January, SIP stoppage ratio had increased, meaning more investors were canceling their investments. I even made a short video highlighting this trend. Coming back to valuations, most experts had expressed concerns on elevated valuations of Indian stock markets. I'm going to rewind and see what they have written. It seems that these were early warning signals for all of us. In March 2024, the then SEBI chief Madhabi Puri Buch said there is froth in small and mid cap stocks and called it irrational exuberance. In June 2024, CJ George, founder and managing director of Geojit Financial Services, who said We are advising investors to book profits in mid cap and small caps and to invest only in large caps. Market analyst Ambridge Baliga talked about SME IPOs, where he said that there is a possibility of more frauds in the SME segment coming to light. If you look at their valuations, most of these stocks have become multi bagger not because they were too underpriced. Former Finance Secretary Subhash Chandra Garg said out of 78 listed PSEs, which is public sector entities, there are few companies such as MTNL that have been making big losses, losing turnover, and don't have viable and growing businesses. But their share prices have run up high. How can such stocks justify a price rise of 8 to 10 times in the last 4 years? Nothing can justify this behavior. Now, let us see how elevated these valuations were. In July 2024, there is a print article on it. The Buffet indicator or market cap to GDP ratio of India was 1.4 times. That means overall stock market capitalization, the amount was 1.4 times India's GDP. That is very high compared to our history. The PE ratio or price to earnings multiple for the Sensex was about 24 times. But mid cap index was trading at 33 times and small cap around 38 times. PE ratio tells us how many times the price of a stock is relative to its earnings. That article talked about railways and defense stocks. Many of these stocks have seen a very high price growth, but their revenues and profit growth were not that much. You can see them in these two charts. We also get some commentary in between by the government through the Economic Survey 2024. In August, you can see an article in Indian Express which says for some time now it has been apparent that stock valuations in India have risen from being expensive to levels that defy logic. Then in the same month, we get a news that FIIs are selling Indian stocks. Financial Times take a notice of it and says foreign investors pull out of frothy Indian equity market. It mentions that some foreign funds have already taken profits and are waiting for a correction in Indian market before re-entering. Then in September 2024 we get more news of how everyone is kind of worried. The New Indian Express mentions Deepak Shenoy's quote on X platform. He says, "It is time to be aware that you are all riding a tiger. There is zero predicting ability on stock movements right now. It is a mad market and will remain one until it is not." The point isn't to keep people warning that it is getting too hot. I have heard this from last December and we are up some 30% or more since then. It could fall tomorrow or it could fall 10 months from now. The better thing to warn people is to stay nimble and stop loving your stocks. When markets fall, even the ones that give you the most smiles today might need a harsh goodbye. In September, Wall Street Journal wrote, India's are on fire. Investors who want to partake will need to keep a cool head as a trading frenzy and rising valuations have potential to spoil the party. And then came the uncertainty from US elections. But before that, what exactly was riding the stock market before September? Let us understand that. The first is the fact that India was the fastest growing economy. The second was corporate results were strong. Third, the government spending was boosting the GDP through defense and infrastructure spending. And fourth was the policy continuity factor with Modi's victory in 2024 general elections. But then there was an undercurrent of some worries which were kind of neglected by others, and those were first, high inflation. India's inflation in the first half of 2024 was around 5%. In October, it touched even 6%. Due to consistent high inflation, RBI could not reduce interest rates. Second was higher levels of unsecured lending. In November 2023, RBI started implementing policies which discouraged unsecured lending or personal loans. Many categories of loans like gold loans, microfinance institutions, unsecured lending, etc., came under RBI's scrutiny, where it found that some guidelines were not followed, there were exuberant charges, and so on and so forth. And then RBI basically made lending to such sectors more difficult. That kind of thing made created liquidity issues and some lending related issues in the Indian banking system. Third is the infrastructure spending started to peak off. In February 2024, that's the last year, there was a news which says road contract awards in India hit decade low in 23-24. If the awards are slowing down, then obviously it impacts the construction too. During April 2024 to January 2025, that is this financial year, the pace of construction has already fallen by 8% if we compare it with the last year. Right now, the awards are rising and hopefully the pace of construction also improves with it. Fourth is the elections and the new government. Due to elections, a lot of projects, be it infrastructure or otherwise, got delayed, and that impacts most sectors that depend on government contract, be it cement sector for housing infrastructure or different government programs. Then the new government was a coalition government, which is a kind of great thing for India, where I have also made a separate video on it. But the decision making takes time. This period also coincided with monsoons, so kind of everything came together and created a lot of delays in implementation of projects or even in delays in decision making. There was also a factor of populist policies announced in various state elections that kind of dampened the mood in the market. Fifth is the consumption slowdown, the biggest worry of the today's India. I've written about how urban India is facing slowdown, how the government has acknowledged these problems by implementing two new schemes. First is employment incentive scheme announced in July 2024 budget. I even made a video on it pointing out that its impact might be limited. The second policy is the tax cut for middle income earners. The government has slashed taxes to almost zero for those whose incomes are below 12 lakh rupees a year. Why do these policies matter? Because, as I've said, that it is kind of acknowledgement by the government that there is a job, income, and spending problem in India. So it is not just about market corrections or investment sentiments. A broader economic slowdown is also unfolding, and the government is trying to cushion the impact. I feel that these five issues started in early 2024 itself, but by July or August we started seeing its impact that resulted in low profit growth in December quarter. Therefore, a culmination of these domestic issues and a bunch of external factors, which we will discuss later, has impacted markets from October 2024 onwards. Now, let us focus on external factors, starting with USA. Trump, his tariffs, and other not so conventional ideas have an effect on the market, obviously. But the most important factors are rising dollar and rising bond yields. Dollar is becoming stronger. By the end of February this year, the dollar index, which kind of indicates the value of dollar, was at 107.6. On 27 September 2024, when the markets peaked in India, it was around 100.38. In the 5 months, it has increased by 7%. But in the past few weeks, the value has declined to around 103%. So currently, if you just look a 1 year gain, it is just 1%. But in the past few months, as I've said, the dollar rose by around 7%. It is largely the Trump effect, which we can attribute it to. That is a huge, and its impact has also been huge around the world, because a stronger dollar means weaker rupee, or for that matter, any emerging market currency. In such cases, the imports for that nation becomes expensive because you are importing and you have to pay more dollars in return. It also means that investors get lower returns when they calculate their gains in dollars. So they sell their investments to remain profitable. Easy. So that is one of the reasons why FIs were selling. It is one of the reasons. Why dollar was rising? What that means to India? Although weaker rupee is good for exporters in India, it is bad for importers, which are more, as India is a net importer country. But RBI is also trying to manage rupees values in directly or indirectly. But how is it doing? What kind of impact it has on the rupee value, and what are the side effects of RBI's actions? All these things I have discussed in a article which was published on Trendline. So I would recommend you to read it for more information on it. Now let's just talk about bond yields. At the start of 2024, US 10-year Treasury yields were around 3.9%. At the end of 2024, they were around 4.6%. Now they are around 4.3%. They have declined in the last couple of months. There are multiple reasons why US bond yields are rising. One is fiscal deficit. People believe that Trump will have to spend more if he wants to implement its policies. But at the same time, he is also cutting the government and the cost of the managing government. So mostly people are unaware like what will be the broader impact on the fiscal deficit, whether it will increase or decrease. Second is inflation. If US inflation rises, then the bond yields will also rise. Third is the risk of US economy getting into recession. Fourth is obviously the uncertainty through Trump's policies. Sometimes there are tariffs, next day he reverses it, and so on and so forth. These are the factors, not all at one time, have kept bond yields up for the last few months. What happens when US bond yields are up? They become more attractive for investors, because if the foreign investors compare their dollar denominated returns from investing in a US asset to the dollar denominated returns from investing in an emerging market asset, they see that US assets will give them higher returns. So not just through higher bond yields this time, they are also having a higher dollar value. Both rising dollar and rising bond yields are beneficial to any investor, and that is again one of the reasons why foreign investors are moving out of India. Here's a comparison of some bond yields data for India and USA. If we are in September 2024 and compare the bond yields data for US and India, here's what it looks like. India's 10-year bond yields have dropped from 7.18% in December 2023 to 6.75% in September 2024. That means gains for bond investors have declined in the first 9 months of 2024. The US bond yields have marginally reduced from 3.87% to 3.79%. They have also lost, but not that much. Now let us add another layer to it: inflation. India's CPI or inflation rate has come down marginally from 5.69% to 5.49%. But US CPI came down by 1 percentage point. Now, if we calculate inflation adjusted bond yields, which is nominal yield minus inflation rate, we can see that real bond yields for India were 1.26% in September 2024, and for USA they were around 1.4%. What does that mean? It means that a foreign investor will get more returns if they invest in US bonds if he or she accounts for inflation. So, here's another reason why FIs are selling heavily in India. Now, let's say we are in December 2024, and has the situation changed? Not much. So cut to March 2025. Here, I have used estimates for inflation rates for months of February for India as well as USA as 4% and 2.8% respectively. In March 2025, the situation has reversed. Real bond yields in India are around 2.8%, while in US they are around 1.5%. So investing in India has turned out to be profitable, or has turned out to be more profitable for a foreign investors. But wait, before you start jumping in excitement and joy, there is a problem, and that problem is uncertainty. What if the assumed inflation of 4% turns out to be higher in the coming months? Or what if the tariffs start in the next few months and then the entire calculations goes bad? What if consumption slowdown worsens in India? So all these things are there. There are a lot of unknown unknowns, and therefore it might not be a right time for a foreign investor to come back in India at this point in time. But many are still bullish on India. Recently, World Bank said that they are bullish on India. Howard Marks has also said something similar to that effect. So there is nothing gone entirely wrong with the Indian economy. It is just about the timings and valuation, and obviously some kind of concerns from consumption slowdown. If there are no heavy tariffs on India, and if inflation remains stable around 4%, then RBI is more likely to cut rates in April. Recently, it has also implemented a lot of policies to improve liquidity situation in our country. So, if things go right, loose monetary policy, which is like more interest rate cuts, will help stock markets. But we have to consider the uncertainties that we talked about just now. Now, the last angle of this story is the China. For the last few years, especially post COVID, China's economy has not performed well. Then, in the last year, the government started announcing various stimulus to boost the economy. Usually, Chinese government prioritizes investments, means that they will announce some rules or reforms that will enable more investments into the country. Say that people will start in investing in a factory, in a building, in a road project, and so on and so forth. But this time, it has focused on consumption because there is also consumption slowdown in China, and it wants to revive it through different measures. When these reforms were announced, which was mostly it started prior to October last year, markets didn't take them seriously. They felt that more is required to uplift the economy. But as the time passed, there were a few improvements in the economy. More stimulus was announced, and investors also believed that okay, that the entire situation might change because of these stimulus. Also, China's stocks were trading cheaper than India's stocks. Then came the DeepSeek episode, the generative AI platform of China, which outperformed US ChatGPT. And that revived hopes in China's tech sector. So, foreign investors sold India and bought China. There are a lot of articles on how FIIs are investing in China and selling in India. Largely, the factors are like the tech sector, the EV sector, the cheaper valuations. Economic revival also is in progress, which kind of makes it more attractive because they can get higher returns in China. But China's attraction could be temporary. Nomura writes that China may outperform in the near term if we compare it with India, but it may not last longer. A few days ago, we saw that China is facing deflation, meaning that prices are going down. That is a sign of economic slowdown. If the consumption stimulus from the government worked as expected, then we would have seen that people jumping across the stores, queuing up the stores to buy more and more goods. And after some time, the prices of those goods will also go up, which will say that okay, the demand has risen, so the prices will also rise. There will be more inflation, but that has not happened. So, whether the foreign investors will start selling China in the next few weeks or not is something that we have to watch. But this is not the news where we can, rejoice on, because if there is a slowdown in China, that means that they will not demand more fuel, food, commodities, and products and services. This could lead to widespread of problems. So we need to pay more attention to what China is doing and what the data says. So, yeah, this is what is happening broadly. See, Indian economies is also having a lot of problems, largely being this consumption slowdown. But there is also a fiscal support and monetary support at the same time. Markets will be volatile as there are many unknown unknowns, and if the situation in general becomes better, whose chances are falling day by day, then market will revive in the month of March and April. But if the things turn worse, whose chances are higher, then there will be more uncertainty and more volatility in the market. People have said that okay, there will be more 5 to 10% correction in the market, which is possible, but I don't think that people will remain resilient like before. There will be more panic and there will be more fear this time around. One thing good about Trump is that he will not keep things dangling. He will just announce one thing after the another every week, and mostly he announces the worst things and then kind of revises it, or returns to the earlier position or delays it. So there will be more volatility, but it also means that there will be some short term gains, or if you make proper guesswork like what can he next announce or all these things. But for a long term investor, I think this and next year will be the years of accumulation. There will be a lot of dips, and you need not buy all the dips because the market has already fallen a bit. And even if it falls more, I feel that start investing in every dip, but in a staggered manner, probably like once in 2 months or something like that. And then you kind of accumulate all those things, try to reduce your losses, book the loss if possible, but still staying calm and not buying and selling in a panic mode is something which I would not advise you. But still, I believe that these are the years of accumulation, and then what will follow will be, good gains. And as I've said earlier, that diversify, diversify, diversify. If you want some suggestions for mutual funds, I believe that multi-asset mutual funds are great in these times. You can watch my video on multi-asset mutual funds which I've made last year. I think most of the things will still be valid, so it's worth checking it out for mutual fund related suggestions. Well, these are my thoughts and analysis of what was happening and what might happen to your portfolios in the coming months. Don't trust me blindly. Read more, watch more, and make yourself more knowledgeable. And before acting on any kind of stock market or any kind of financial thing, consult your advisor. And so these are the things we have covered today. Why Indian markets are falling, what is the relationship between India and US bond yields, and how that is impacting overall capital flows in our country, and also what is the China factor. Let me know what do you think about the markets, where they are going, what will happen in the future. All these things, please write something in the comment box. And thank you for watching, and if you like it, please don't forget to share this video and hit that like button, and yes, obviously subscribe to the channel. Thank you very much.